Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And I know we're about to open up in another volatile period, especially in the technology sector. So let's go ahead and get started and talk a little bit about what we saw at the end of last week and what we anticipate this week is going to look like. So a lot to cover, so let's go ahead and get started. Before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So the primary question that we want to try to answer from investors is that, are we in a risk on or risk off market? We obviously saw a very big acceleration to the downside on Thursday and Friday. Nasdaq 100 was down 10%. Intraday between Thursday and Friday, gave back a lot of its losses on Friday afternoon, but this morning looks like the Nasdaq 100 index is about to open substantially lower again, while the rest of the market is actually holding up relatively well. So the question that we're trying to answer here is, where are we headed next? So what we're going to do is we're going to look at some of the indicators to answer that question. We'll take a look at the major market updates, look at where the major levels are, where the major markets are trading, what levels we're paying attention to that give us some idea as far as targets, potentially to the downside if we do continue to see that acceleration to the downside. Take a look at some of the economic data that we got on Friday and how that influences how the market is viewing both monetary and fiscal policy. We are starting to see some moves here in the commodity markets that do have some reflections on the sectors. And then what we'll do is we'll take a look at the broader sector review. We haven't taken a look at the sectors in a while, so we're going to take a look at all the sectors. And then if we have a few minutes at the end, we'll open this up for Q&A. So the primary question that I want to help investors answer this morning is on many people's minds, especially for those of you that may have some positions in technology names, is really, is this a sell-off of what we considered overextended markets for the past couple of months? Is that over, or is this going to continue going, leaking into this particular week? So what I'm going to do here today is share with you my charts, my indicators, and the economic research that I'm currently paying attention to inform the decisions here for the market. So first off, what I do want to point us to is one indicator that I've spoken about quite a bit here, which is the ratio of the 3-month VIX to the ratio of the front-month VIX. When we see that the 3-month VIX is trading, when the front-month VIX is trading at a higher level than the 3-month VIX, this ratio falls below 1. The last time this ratio fell below 1 was on February 21st, right 2 days after the peak of the markets, as we saw it decline substantially and remained that way for quite some time until late in April, during which we had one of the fastest sell-offs we've ever seen in the S&P 500. Right now, that indicator is hovering just above 1. Now, on Friday, intraday, it did reach 1 and then came back to close into the 1.13 area or so. But on Friday, we did end up closing here at 1.01, just above 1. So the question that we're going to pay attention to here is whether this indicator continues to go below 1. If it does go below 1, that certainly puts us in a more risk-off market. However, keep in mind that the VIX is the volatility for the S&P 500. What's really driving the downside or acceleration to the downside right now is rather the Nasdaq 100 index, specifically the FANG names within the Nasdaq 100 index. Now, there isn't a 3-month VXN index, nor is there a FANG VIX volatility index. So those are some of the things that we're going to be paying attention to right now, is using the S&P 500 as a proxy, but keep in mind that it's not the best proxy because we have seen a significant decoupling between the Nasdaq and the S&P. So the primary question that we want to try to help answer right now is that, number one, what we saw was a significant acceleration to the downside here between Thursday and Friday. Now, Friday, we did manage to get back above just around the 20-day moving average of the Qs. Right now, we're about to open up below that 20-day moving average, which certainly informs our directional view that there could be further downside. So I wanted to put this broader rally into context from the March lows all the way to the highs we saw just a few days ago last week. Put that into context as to where we currently are. So far, we've pulled back roughly. Keep this into color so that you have a better sense. But from my perspective, there's a few levels that I want to pay attention to, 250 and 270. These are two levels that I want to pay attention to right now on the Qs. The reason I want to pay attention to it is because the Qs spent the better part of about a month in between this level before breaking out to the upside and going on this really overextended move to the downside. So we did manage to get back into the top of that range here on Friday afternoon. We're about to open up here just above that range. So at the very least, my take is that if the Qs extend its move to the downside, it's going to get back into this range. And the low end of that range is about 250. So that would be my initial target here to the downside if I'm looking for further consolidation here in the Nasdaq 100 index. And keep in mind, the February highs is around 238 or so, 239 or so. So that is the level to remind ourselves, because the S&P 500 has already gotten back to those February highs. The Nasdaq 100, as you can see, is still about from this morning's market level is still about 8 to 9% above this 239 level, 238 level. But 250, in my opinion, would be a short-term target here to the downside for the Qs. Now, if we look at the S&P 500, the S&P 500 already got to the Nasdaq 100 index, so it's actually already paused and gotten its way back. It's about to open up just below that level. So if we do get some consolidation here to the downside, we have 323 to the downside on the S&P 500. So those are the levels that we're paying attention to on the broader market indices. But the one thing I want to point out here is that we're starting to see this rotation out of technology, out of the big cap names, into small caps, into the equal weight indices. So the small caps, as you can see, after the Nasdaq 100 fell about 10%, is still only down about 3.5% from the peak from last week. So the small caps so far holding up very well. Also, equal weight indices holding up relatively well. This really speaks to the fact that what we're seeing right now, in my opinion, is not some larger structural shift in terms of how markets are thinking and risk on, risk off. This is simply, in my opinion, just the froth that we've seen in the technology space being brought back to reality. So the overextended, the exhaustion that we've been talking about over the past couple of months, we kept saying we don't know what's going to break the camel's back, but what we did see is that break last week. We're starting to see that, but we're not seeing that spill over into other sectors. And when we look at the sector reviews, it'll become a little bit more apparent. But when we look at small caps, when we look at the broader market, meaning if we look at most of the companies in the S&P 500, we're not seeing this type of larger structural sell-off. That's why we don't believe that this is the start of a bigger correction here in the broader markets. I do think that there's further downside here potentially for technology, but I do think that those moves to the downside are going to be quick and violent, but they're not necessarily going to be long lasting, in my opinion, especially if we look at the broader markets. If we also look at treasuries, there was a bit of a flight to safety here on Friday in terms of treasuries, but we're not seeing substantial moves here from the fixed income markets. They're still trading in this range here, in this 160, 170 range or so. And we expect that this might continue back into that 170, 172 range to the upside here for TLT, keeping yields for the most part in this range-bound mode that it continues to be in. Fed policy on Friday afternoons, the Fed Chairman Powell spoke. We still believe that the Fed's committed to long-term keeping interest rates relatively low, but inflation expectations continue to get higher here. So that puts this TLT in more of a range-bound mode to kind of play in between these two views, if you will, of the markets. Now, if we look at the Nasdaq 100 Volatility Index, this is one that we do want to pay attention to because it is now at a 4-month high. Looks like we're going to open up a little bit higher again today. If we get back above that 48 level, we're really talking about a high that hasn't been seen since the coronavirus crash. Now, is there as much uncertainty now as there is during the coronavirus crash? I don't think so. And that's why I do think that if, any moves above 48 is an opportunity to potentially sell volatility. So that means selling put credit spreads. And I advocate using credit spreads in this type of market environment because you could get an acceleration to the downside. And you do want to protect yourself with limited risk strategies so that if this doesn't work out and this does become a bigger structural pullback here in the markets, that you have limited risk on any of the strategies that you take. Now, we did start to see some acceleration here to the downside on crude. We've been talking about this triangle on crude for quite some time, how it's been trading in a narrower and narrower range. And we're starting to see a breakout here to the downside. So this is going to put some downside pressure here on energy, which is something that we're going to talk about. But this downside move here certainly puts crude oil back into the low 30s as a potential target, potentially even as low as the high 20s as a target here to the downside, as oil demand just cannot continue to pick up and inventories continue to build. This is putting downside pressure here on energy, but also oil. Now, conversely, on the flip side, when we look at copper, copper continues to make new relative highs here. We're actually talking about a multi-year high here on copper. It's gotten back above that $3 major level, which has been a significant level for quite a few years, $3, as you can see, managed to break above it. So this could potentially puts copper substantially higher. So this has some ramifications because copper is a good indicator of industrial demand. We've seen industrial demand from economic indicators continue to pick up, not just here in the US, but globally. And, puts copper at the same time, when we're looking at some of the mining stocks, this is some of the stocks that have seen some strength, mostly due to gold recently in the news, but we're starting to see again copper rise higher. So we do have some of the miners that can potentially see some gains as a result of copper moving higher here. But gold not moving a whole lot, but copper starting to see those moves. So the mining stocks that are focused on some of those names, those are the ones that I would pay attention to. Now, we did talk about this a little bit last week, but about the fact that job numbers is going to be a primary driver here. Now, one of the things is that job numbers has been a huge driver of equity gains here in May, June, and July. In August, the same thing. The numbers came out better than expected, 1.4 million roughly, a little better than the 1.31 that was expected from the survey. So, and unemployment coming down substantially. The survey coming in about 9.8. The actual numbers came in below 9%. So we're seeing some substantial gains here on the jobs front. But the one thing I do want to point out is that the jobs recovery has been very uneven from the perspective of the household income, and what is the likelihood of seeing unemployment in your or income loss, if you will, in your household, depending on your income levels. And it is very, very bifurcated here. So when we talk about a K-shaped recovery, there's a lot of talks now, instead of a V-shaped recovery, you have what's called a K-shaped recovery, meaning you have two segments of the market, the higher income segment of the market seeing this type of V-shaped recovery, and the lower income of the recovery seeing more of a W-shaped recovery. And we're starting to see this in the economic numbers here. So this is one that I do think is worth paying attention to. But the one thing that has shifted a little bit, I would say, in this job report versus the previous few months, is that the previous few months, we've been looking at those job reports as an indicator that jobs are coming back into the market. Now that we've had 4 back-to-back months of stronger than expected job growth, one of the concerns now is the fact that as job recovery becomes relatively strong, you have less and less urgency for further fiscal stimulus. This is likely going to put the urgency of the next round of stimulus further being delayed even further down the line. There was some talks that, if things got a little bit worse, if markets started to correct and we're starting to see job losses compound, that would put more of an onus on on Congress to pass a second stimulus. But when you see back-to-back strong economic numbers like this does put that on the back burner, and that actually causes some weakness here. So the market's got a little ahead of itself, and markets are forward-looking, and that's okay. Markets were forward-looking, anticipated this strong jobs growth, but now that we've had this strong job growth, and now the markets may be looking a little further ahead and say, now that we've had such strong job growth, we're not expecting the same probability of stimulus money is likely going to be reduced. And that's why we're starting to see a little bit of repricing here in the markets as far as the exuberance on the economic recovery. So this is one segment of the market that we're paying attention to as far as how the market digests is starting to shift a little. These strong economic numbers, actually point us to potentially a lower market. Now, when we look at the recovery, this is really where we still continue to see on high frequency indicators some strength here. We continue to see declines in terms of COVID-19 cases. We will have to see whether Labor Day weekend sees a bit of an uptick here, as obviously a lot of people are out and about this particular weekend. But overall, we are seeing economic trackers, high frequency economic trackers across the board, starting to see gains, especially as the number of cases continue to decline. The 7-day average here in the U.S. has now declined below 40,000 cases a day. Yesterday, we just had only about a little over 20,000 cases, which is likely going to bring down the average even further. So this is really where the recovery and COVID-19 cases continue to improve and are showing that we are on track for recovery. So this is, again, the economic numbers starting to catch up a little bit with the equity markets, and the equity markets looking at these numbers and saying, okay, as the economic recovery comes into, starting to take shape, that this gives us more of an idea as far as where markets can go. So what we're going to do today is we're going to take a look at the broader sectors, and we're going to really, again, try to paint the picture that, yes, we are seeing this high amount of volatility here in the markets, in the segment of the market where we've seen a lot of momentum and a lot of exuberance, if you will, that's starting to come off. But again, we believe that this is fairly contained here to just one sector right now. And if you look at how the markets are responding here this morning, that's also something that points us to in that particular direction. So again, this is the XLK, which is the technology index, very similar to the QQQ chart that we looked at the very beginning. This is the February 2020 highs. As you can see, we're still a far cry above that level. So right now, what we've had so far is a big move to the upside above the 20-day moving average, a huge correction last week on Friday. And what we have here is a bit of a pullback here into the 20-day moving average. So the fact that we've now gotten rejected off that 20-day moving average and opening up around 114 on XLK leads me to believe that there is some further downside here for XLK, somewhere into this 104, 108, 110 area or so. Just like how markets can overcorrect, can overshoot to the upside, we're starting to see markets potentially overshoot a bit to the downside into this 104, 110 area. Now, I will say that moves to the downside into this area very well could last just a couple of trading sessions. You could see a big move to the downside, get into that area, resolve some of this exuberance, if you will, shake out a lot of weak players, and then the markets resume its sort of normal operations, if you will. So this is really the only sector that we are seeing any movement in this morning, with the exception of energy. But energy is really driven by the fact that we've seen this acceleration to the downside here in crude oil. And this energy has been dying a slow death over the last few years. Energy has been underperforming the broader markets since 2017, 2018. And all we're seeing right now is just a continuation of that and a bit of an acceleration of that. As you can see, after having what was a very strong recovery, we have just continued to see lower highs and cannot manage to break these highs. And this 34 level here is a support level. A break below that really puts energy into a really bad space, into the low 30s, high 20s. And that's what I'm seeing here for energy. Energy dying the slow death. Watch that support level. Break below that support level, I think, will bring some further downside. As we look at the other sectors, this is really where we're seeing, the other sectors holding up relatively well. And part of it is because barely have budged here over the past couple of months here. As you can see, healthcare barely moving after breaking above that February high. And they broke that February high pretty early here in early July, but hasn't been able to make any progress here, pulled back to that support level, and now can continue to potentially move lower as you get a rotation out of momentum and tech into some of these sectors like healthcare. If we look at XLU, normally we would see this type of rotation into sectors like this, especially with yields at such low rates, but utilities hasn't quite managed to break out here. So this is one that I'm paying attention to. The 200-day moving average continuing to provide resistance, but it also has higher lows. So it continues to coil into this tighter triangle here. The question is, which way does it break? Now, if we look at yields, that would certainly suggest that you get a break here to the upside, just simply because of investors trying to seek yields, not able to find it. And arguably, when you're looking at a sector like utilities that is giving you 4 or 5 times the yield of a 10-year Treasury bond with relatively the same volatility, you're going to likely see some gains here in those particular sectors. Staples, one of the strongest sectors right now outside of technology. As you can see, a very strong, steady growth here to the upside. Got a little bit moved to the upside, pulled back here with technology last week, and is just sitting at that support level. Yes, we could break below that support level here this week, but if you look at pre-market, this sector hasn't moved down with the rest of the market here. And we're seeing that pretty across the board. Same thing with XLY. XLY has a lot more room to the downside, in my opinion, than Staples. This is one that I do think that you could see some further downside, because XLY does have quite a few names that fall within that FANG sector, specifically Amazon, that could see some move to the downside. We are also seeing home improvement kind of moderate a little bit here. Lumber prices coming down a little bit. We're seeing Home Depot, Lowe's, home builders giving back some of its gains here. So from that perspective, with Home Depot and Lowe's providing a pretty large chunk of this particular sector, I do think discretionary over the next few trading sessions is likely to see some further downside here. XLF, another one of these coiled potential moves here. XLF, same thing to utilities. Potentially break here to the upside. We're starting to see this, again, rotation out of technology into some of the worst performing sectors. Financials, one of the second worst performing sector after energy. Can we see this rotation to financials? We certainly saw a lot of strength here in financials on Friday, one of the only sectors that was actually positive on the day, with the exception of industrials and materials, while every other sector sold off. So financials perhaps playing a little bit of defense here as we see some rotation out of technology. And when we look at real estate similar to utilities, arguably we saw that breakout here a little bit here on real estate over utilities. However, I do think that we're starting to see a lot of the numbers out of depending on what type of real estate company you're talking about, but a lot of the rentals in some of the urban areas, especially the real estate companies that have exposure to office real estate, these are the ones that are starting to see a lot of cracks grow. And that's why I think there's going to be some downside pressure here on this particular sector. And I certainly think that at the very least, what it does is it limits the upside here. I think the upside here is fairly limited. If anything, it's going to trade more range bound. But I do see growing risks of this sector breaking down to the downside here in terms of real estate. We're seeing this across the board, but again, the residential, especially the ones that have relatively high exposure to urban areas and office space, those are the ones that we think are going to see some further weakness here. Communications, also one of the sectors, not as much of a with the exception of Netflix, which is really the only big name here in this particular sector that is overextended with a tech name, but there is still some downside here into that 58 area, which is the February highs. So communications could see a little bit of a pullback here, but certainly not to the same extent that we see in technology and discretionary. but communication certainly one that we think could see a little bit further downside here. XLI actually is one of the sectors that we quite like here, and we think that there's some upside here, especially as we saw those copper prices continuing to rise, telling us industrial demand picking up here. Same thing with industrials. We're seeing big moves from John Deere, from some of the home builder stocks like Sherman-Williams, Restoration Hardware. This is really one of the stocks that I think has some upside, or one of the sectors that has some upside potential as we see this rotation out of technology into sectors like materials and industrials, and both of those sectors holding up relatively well here on Friday. We look at materials, same thing, materials breaking out above that $62 level. Similar chart to healthcare, I would say a little bit. We've talked about this sector for quite some time, but this is one again that sees some potential upside here as we get that technology rotation out of technology. So those are the things that we want to cover with you here today. Like I said, the main theme here is the fact that we have this rotation out of technology, and the question is whether that rotation is going to drive a larger pullback here in the markets, or if it's going to be self-contained within the technology sector. So far, if we look at how the sectors are responding, if we look at the indicators, it seems to at this point indicate that this is contained to technology. Can this spill over into other sectors? It absolutely can, but right now we're not seeing that. We're not seeing markets react that way. We do see some further downside here in technology. We expect those downsides to be fairly quick and violent. So you may not see this last for very long. So for those of you that have puts here in the markets, or maybe thinking about putting on some puts this morning, be careful about that, because you could see a very fast, violent sell-off that only lasts, similar to what we saw on Friday, where it's mostly an intraday move, and by the end of the day or by the end of the week, we're seeing markets back to somewhat normal levels, even though they might be another 5-7% below where we're currently sitting. But these moves that we're seeing are fast and violent. They don't last very long. That's how we see this market playing out. Now, if this does spill over into other sectors, and we start to see the S&P 500 accelerate to the downside, if we see small caps or the equal weight indices start to accelerate to the downside, that would be the indicator to me that things have spilled over, and it is time to start hedging your broader portfolio rather than just some of the tech names that you might have in your portfolio. So that covers what I wanted to share with you here today. Again, these are tough times in terms of trading the markets, but this is really why diversification and risk management is so important. Don't have all your eggs in one basket, especially in short-term options where all your options are expiring in the same week, so that a week like last week doesn't blow a hole in your portfolio, that you're able to roll those positions into the following week and continue to play for short-term volatility and take advantage of this volatility rather than being on the defense. So with that covers what I wanted to share with you. I hope that you guys find this useful in helping you set up your day and understanding, where this acceleration is coming from and how far it's likely going to go to the downside. With that, thank you so much. I hope you guys have a great trading day.